Let's talk about the engagement letter. Now, in your notes it says, once the auditor has made the decision to accept the engagement, the auditor is required to send a written engagement letter or a comparable written agreement to the client. In it, the auditor will confirm the scope and nature of the engagement and the responsibilities of the various parties. So basically, we need, and here's the tricky part, you are required to have some sort of written agreement. It is recommended to be in the form of an engagement letter. So the homework trick sheet will say, or the exam questions, hey, do you have to have an engagement letter? No, but it's highly recommended, but you need some written agreement between you and the client. And basically, one of the things we'll learn in the regulation exam for business law is we have this thing called the statute of frauds. Not a statute, but a statute of frauds. What is a statute of frauds? That says that in order to enforce a written agreement, basically, if I'm suing you, I have to show you signed it. If you sue me, you have to show that I signed it. So it doesn't need to be signed by both parties, but it needs to be signed by the person being sued called the defendant. There's a person suing called the plaintiff and the person defending themselves called the defendant. So if I'm suing you, I have to show you signed it. If you sue me, you have to show that I signed it. Generally speaking, in the real world, both parties sign the contract. That way both parties can enforce it. Now, with the engagement letter, it says here, the auditor will confirm the scope and nature of the engagement and the responsibilities in various parties. The auditor's responsibilities include conducting an audit in accordance with GAAS, informing the client of any improvements in control or economy of operations. The client's responsibilities include making available all records. We call that completeness. We want to make sure that everything is included. So if I want to see something, if they don't show it to me, that's a problem. That's a scope limit. Not limiting the scope, paying the fee-based. A written understanding with the client will also include a statement that due to inherent limitations, internal control, material misstatements may not be detected. So basically what it says is we'll define this term called inherent limitations. That means in any system, these things can always happen. Errors, irregularities, collusion, management override. These are things that can always, I don't care how great the system, but 2 plus 2 is 17. Whoops, I made a mistake. It flows through. It ends up in the financials. That's called inherent limitations. So we're going to specifically mention that these things may exist and may not be detected. Also, identification of what? The applicable financial reporting framework. So we're going to identify that as well in the letter, plus reference to the expected form and content of the report. In other words, you know, what kind of opinion do we expect to give? That's basically what we're looking at. So with the engagement letter, again, it mentions that we're required. What is included in this? What kind of sections? Some of the sections include the objective and scope of the audit. So what is the objective of the audit? What is the scope, right? The magnitude. Responsibilities of the auditor. The auditors, what are my responsibilities? What are your management responsibilities? Responsibilities of management and identification of the applicable financial reporting framework. Other relevant information, reporting, which is the expected form and content, what kind of report we expect to give, and inherent limitations may exist, so may not detect some material misstatements. So again, because I love them so much, I have to give you another memory aid or mnemonic. Facsimile. That is your engagement letter. So what should be in there? We should talk about the fees, the auditor's responsibility with respect to irregularities, things that are not legal, or errors. So when I break this up, irregularities and things that are not legal, these would be illegal or what we call non-compliance. Errors, irregularities, that could be maybe fraud and errors. We've got confirmation of engagement, the scope. We're going to look at internal control, management responsibility. So all of these are things that we're going to be looking at as far as the agreement. So that's what's in the engagement letter. I don't expect you to memorize it, but it's important that you understand because they've asked questions before where it says, here's a phrase, what document did it come from? And it's a task-based simulation where you've got to kind of match. Here's a phrase, here are the choices. Was it an audit report? Was it an engagement letter? Was it a letter of audit inquiry? Was it a written communication with the client? Was it an internal control report? Was it an attorney's letter of audit inquiry? So where did it come from? Where did the phraseology come from? Don't have to memorize it, but it has to make sense. If you look in your notes, you'll see here an engagement letter. Here's who it's written to, either the audit committee or those charged with governance. Then it says, Dear Mr. So-and-so, these are the objectives and scope. It says, you've requested that we audit the statements of the company, which comprises of, and you mentioned the statements, the balance sheet, income statement, cash flows, statement of changes for the year then ended, and the related notes. We are pleased to confirm the acceptance and our understanding of this audit engagement by means of this letter. Our audit will be conducted in the objective of expressing an opinion on the statements. So what is our objective? To give an opinion on the financial statements. Then responsibilities of the auditor. What is the auditor's responsibility? That we're going to do our audit in accordance with our generally accepted auditing standards, GAAS. Also, that we're going to look and use reasonable assurance. We're going to use professional skepticism, and we're going to obtain reasonable assurance about whether the statements are free of material misstatements. And then we define what an audit is. We also talk about these issues, whether due to errors or fraud. Here's errors versus fraud. So we're going to say and specifically mention errors, frauds. The next thing, because of inherent limitations, and I'll define those in internal control, but basically they could be collusion, obsolescence. It could be, for example, when two people get together and they collude, they override. It could be, for example, just making a mistake, an error. So it deals with competency of employees. So there's a whole bunch of different things. It says because of inherent limitations, an unavoidable risk that some material misstatements may not be detected exists, even though the audit is properly planned and performed in accordance with GAAS. In making our risk assessments, we consider what? Internal control. Here's internal control. Let's consider internal control. It says we're going to look at internal control, but not for the purpose of expressing an opinion. And I'm going to expand on this because we go out to the client. If it's a PCAOB public company audit, you are auditing that with the purpose of giving an opinion on internal control and an opinion on the financial statements. If it's non-public, then your goal is to give an opinion on the numbers, but not necessarily on internal control. Here, non-public, what are we saying? That our goal was not necessarily to give an opinion on internal control. However, if we come across any significant deficiencies or material weaknesses, which is the inability to prevent, detect, and correct errors, we'll talk about that in internal control, then we're going to write that or communicate that in writing. Responsibilities of management. So what is management's responsibility? We kind of mentioned that earlier. We're going to clearly mention that management is responsible for the presentation and preparation of the financial statements. They're responsible for DIM, design, implementation, and maintenance of internal control. So these are some of the things, and also the applicable financial reporting framework. They're responsible for choosing that. It says responsibilities. Our audit will be conducted on the basis that management acknowledges and understands that they have full responsibility for what? Let's see. A, for the preparation and fair presentation of the statements in accordance with accounting principles generally accepted in the U.S., for design, implementation, and maintenance of internal control that are free of material misstatements, whether due to error or fraud, and to provide us with access to all information of which management is aware that is relevant to the preparation and fair presentation, additional information that we may request that management for the purpose of the audit, and unrestricted access to persons within the entity necessary to obtain all the information. And then as part of it, we're going to get a written confirmation basically saying you owe us a management rep letter. So at the very end, we're going to get a management rep letter called a management rep or a client representation letter. This is a letter you have to get. You must get this. And it's basically a letter that talks about all the representations they made to us during the course of the audit. We will talk about that in the audit evidence chapter in substantive testing because it's really important. Again, we'll go through the details of what's in that letter. Other relevant information, they'll provide us a list of schedules. Basically what happens is the client usually prepares the lead schedules, and then we will go through and prepare support schedules or get those from the client, and we'll go through and audit those in detail, which we'll talk about down the road. The fees, and then reporting. Here's reporting. We will issue a written report upon completion of our audit. Our report will be addressed to the board of directors. We cannot provide assurance that the unmodified opinion will be expressed, unmodified, clean. Circumstances may arise in which it is necessary for us to modify our opinion, add an emphasis of a matter or other matter paragraph, or withdraw from the engagement. So we're saying, hey, we could give a clean opinion, or we might have to add an explanatory called an emphasis of a matter or other matter paragraph, or we may have to go, dude, I'm going to give a disclaimer. I need to withdraw from this engagement. Please sign and return the attached copy, signed by me, partner Roger Phillip, merci beaucoup, and acknowledged, agreed by them. Again, as I mentioned, both parties need to sign this because it's very important that we know what it is that they're clearly taking responsibility for. Again, the auditor should not discuss in detail audit procedures that will be performed. Why not? Because we don't want to give away, right? We don't want to tell them, hey, we're going to be looking at this and this and this and so on. So it says here, obtained during the audit, partially because the effectiveness of many procedures depends on the client not knowing in advance what specific evidence will be examined. So we don't want to give that out. We want to be careful, make sure that we keep it on the down.